Hi, folks. Welcome back to Just Ask George. David Wolf here, co-dude with the head dude of BH Capital, George. Welcome back.
Co-dude, David Wolf, man about town, a.k.a. Firewolf. You're on fire this week.
Yes, I'm having a good time. A lot of demand for capital, and we're accommodating.
Fantastic. I love these stories.
It's good. Well, it's business development for us, and it's new capital deployed into the entrepreneurial market space, which is you. You may be wondering why I have this very large volume here. This is from the library of BH Capital, George Lovato, and I'm going to read a definition of an instrument we call a debenture. This is closely related, by the way, to a segment we did about selling notes to raise capital. Right,
selling
George?
notes. Remember we had that little running joke about that in the movie Amadeus, when the Prince of Austria is asked by Amadeus, what did you think of my opera? And the king responds, too many notes.
Absolutely.
So the moral of that story is you don't want to sell too many notes. You don't want to borrow your way out of debt, but debt is a good, solid instrument. We talked about how to deploy those notes to kind of provide some footing capital for your business. And now we're going to talk about something a little more sophisticated.
Always extraordinary, always informative. George Lovato, Jr. Okay, debentures. You'll pardon me while I adjust the refraction. Of course, it's radio, so you don't care what I look like. Debenture bond. Bonds not secured by any specific property, but issued against the general credit of a corporation or government. So, George, I'm going to just ask George, what the heck does that really mean for us?
Oftentimes, I see transactions, whether they're associated with A&D, acquisition and development for developers, real estate projects, all the way to expansion capital, to even other businesses buying other businesses. And it's just not a fit for a commercial loan transaction with a bank. Banks can do what they want to do in many cases, but they have their little small universe they stay in, and so the client will ask, well, then how do we form this debt? And the response is, well, we'll look at bonds or debentures. And the second question is, well, okay, what's that? But where, who's going to do this? And then we go into the process of how that works. But here's a prime example of where a debenture would fit. It would involve, let's say that you've got a company that has a line of credit and its receivables are securing that line of credit, timing difference financing.
Sure.
And the corporation is in the midst of expanding, but there are no other real assets to look at that you can use as collateral to secure new borrowing. So you go to a marketplace that is very familiar with that need, okay, for that type of debt, and you form an instrument, and that instrument is based on the good faith and credit of the corporation. So people. Yeah. People make up corporations. So if you got good people in the corporation, and do you have a solid, sound opportunity, and does the corporation have the capacity to pay that debt back? Now, that takes a ton of analysis to make sure that all of that works, and a lot of interviewing on the people side. But that instrument, in effect, creates debt, and in institutions, other institutions will come in and say, well, this corporate debt is pretty good. The company, it's a pretty good opportunity for us. The company is making profit. There's solid management. This is a long-term contract that they've got on their hands for multi-millions of dollars. And I really don't see very much risk in the repayment because it's a good company with good people. And so you then buy those debt obligations. You're funding them. You get the instrument, they get the cash, and the company becomes an issuer. Okay, they're issuing these debentures, and then the structure of them is very attractive. There's a better than average interest rate. Mm-hmm. So they're
priced for the risk.
Right, they're priced for the risk, but they're commercially competitive. So you may see something like at 7%. You see them all the time in the Wall Street Journal. Ford Motor Credit issues $1 gazillion at 7% for 10 years. That's an example of what I'm talking about here. In the small business space, however, okay, the small businesses can't deploy $1 gazillion.
Sure.
So there's another space there where institutions in that have an appetite in that, say, $1 million, $3 million, $5 million range.
Yeah.
And as a result of the need for the corporation, good, solid faith and credit, et cetera, et cetera, et cetera.
Yep.
Bingo. You've got it won. And you've got a corporation getting a better than average yield.
Mm-hmm.
And you've got a corporate that's made an investment, in these debentures, and then you've got a company that has borrowed the money that has found a way to accurately deploy those dollars, put the money in the right space so it gets its highest and best use.
Are there particular buyers for this range you described? It's more
yes.
appropriate, and
absolutely,
we know who they are.
Absolutely,
all right.
They're out there. They typically look for these types of transactions because their money's going to work at a better rate than as it sits in a CD earning 1.5%.
It's an opportunity comparative kind of thing. In terms, all right, you mentioned the analysis is quite extensive.
It's extensive, and let me say one other thing. Let me say this about that.
Please,
is that in the process of forming those debentures, it's important to note that the company has to be able to withstand the weight of that debt on their balance sheet.
Sure.
In other words, you don't want to have the company borrow its way out of debt.
Right,
Okay.
And this is key. We see this a lot. The idea, from a management perspective, that's how you solve a problem. No, that's a management problem, but we'll say that for another show. But yeah.
So the analysis, it's peeled back in a multitude of layers. But one of the first elements is, what is the business of the business? We were talking about this yesterday. What is the business of the business, and what are they doing, and how does that relate to the opportunity that they need to finance? So you spend a lot of time understanding how the company generates its revenue. Okay. Where does it come from?
Where does it really come from? Yeah.
And how efficient are they? How efficient is the company at managing its business?
Yeah.
So those what sound to be very simplistic analytical questions are actually very, very, very complex.
Okay.
Then, I always say this: people. It's not, companies aren't pieces of paper floating around in the corporate universe. Companies are made up of human beings. You're asking a question here. Well, I've got nothing to lean on. This is good faith and credit of the corporation. But really what that's saying is, how good are the people?
Yeah. It points right back to the people.
It points right back to the people. Do they manage well? Are they individuals of high character? Do they have the capacity to understand what this means? They're going to get a $3 million, a $5 million dump of cash that they got to pay back. And I mean, it's partially about the reputation that those people have created. So there's a lot of due diligence on the people, and then it comes the structure part. So what kind of capacity do they have on interest rate so that you're not charging so much? You're actually increasing the risk by charging them a lot for the money. So is their capacity at 7? Is it 7.25? Is it 8? Where is it?
That's interesting because you've got market and you've got capacity, and these have to sort of connect.
And the buyers of these debentures get that. Okay. So they're doing a lot better. And listen, my personal portfolio, I have a ton of corporate debt. And as opposed to just leaving it in the money market account. I mean, there's cash in the checking account, but as far as investments go, I'm not a real fan of CDs. I get the whole they're insured kind of thing. But there are a lot of corporations out there like General Electric and Ford Motor, and you can go on for, even in the 2008 meltdown, those corporations were still paying their obligations.
Sure.
And so they realized that debt, that stream of debt that they constantly tap into through their investment banker, that has to be maintained. So it's probably the last thing they're not going to pay unless the company is imploded. But I don't make investments in companies that are kind of on the edge. That money goes into the big blue chippers that have had a long unstoried past when it comes to repaying their debt. Same thing has to happen in this market. Even if it's a $5 million debenture, the corporation has to have had a history of repaying its obligations.
I wanted to ask you to frame it out for the business owner listening that sees this as an opportunity. In general, working with us, BH Capital, how long should they have been in business? I understand the people part, and that's another analysis. I can't ask the question.
Right.
We've already defined what you're looking for there.
Yeah.
But in terms of the buyers of these, how long should the business have been existent? In other words, how do you define a corporation that's appropriate?
Where's the edges of the box?
In the smaller business space. Yeah, the edges. Right.
I generally say that the older the company, the better you are.
Sure.
Sure. So where is it not going to fit? It's not going to fit with a corporation that's maybe been in business 2 or 3 years, seen relatively uncontrolled and rapid growth.
Okay.
Very thin pre-tax bottom line. Mm-hmm. A lot of inefficiency in the P&L. And there's sort of a leap. You've got a company that has a 3-year-old company that has an opportunity to double its revenues with a new contract, and they've got to fund, the cost of sales, the startup costs, in getting this rolling.
Yeah.
But it's a new space for them,
right?
And so it's probably not gonna that may not work because good faith and credit, long history, managing efficiently. They're really not fitting in there. So
okay.
My benchmark for the outer edge of the box in terms of aging of a company is like 5 years.
Okay.
If I've seen 5 really solid years of performance, I'm liable to review that. Now, on the other side, when it comes to acquisition and development, A&D, mm-hmm. And I get this all the time. People come back and they say, well, this is a startup. Well, the developer's done this how many times before?
That's a huge point.
Yeah.
Because we see bios of guys that, yeah.
Exactly. So this time it's about the developer. So he's the company.
Yeah.
All right.
Yeah.
Has he had a long history of being successful in the acquisition and development space?
Okay.
So this is where debentures will fit. Those transactions are 20, 25, 50, 100 million. When we see them, that seems to be the sweet spot of what we see most. That's where debentures work.
Right. Where a startup isn't a startup.
Where a startup isn't a startup, and you're really, back to the people thing, you're looking at that developer and his history. And, then there's a lot of market analysis that has to be done, potential capacity for absorption of the product that's being built. Will it be sold? Will it be rented? So on and so forth. Now, large real estate investment trusts utilize those instruments, okay? But since there was this little sucking sound in 2008, or a flushing, I might say. Yeah. Banks have really stepped away in a number of different areas. It's hard for them to make loans when it comes to timing difference financing. It's hard for them to, make equipment loans. They're constantly criticized by the regulators. There's just a lot of tough space for them, and so we've seen a proliferation of the development of this kind of debt, and it works, but it doesn't work for everybody.
Excellent.
it's a real narrow group.
Good stuff. Now we're going to do a follow-up segment on debentures.
Yeah, we're
correct?
going to give you an example in part 2 where we're going to talk about where it was absolutely. This is almost a stupid without a license story.
Okay.
But we won't go there with a stupid without a license. But it almost borders on that. But it is a classic case where someone or a group of professionals just didn't get it.
Okay.
And so it was the perfect instrument, and
they just didn't understand why that's appropriate.
Yeah, and they didn't believe there was a marketplace out there, so they kind of over-processed everything.
Okay, well, we're going to hit that in the next segment. Look for that. bhcapitalltd.com is the website. George Lovato Jr., head dude over there at the merchant banking firm. And I'm co-dude David Wolf. We'll see you on the next segment of Just Ask George.
Bye-bye.